Let's start with something that feels low-key unfair. You pay your bills on time, you avoid debt, you don't overspend, you don't finance random stuff you can't afford. You're trying to be responsible, right? And then one day, boom, you apply for a mortgage or a car loan or even just a credit card, and they tell you your credit score isn't strong enough. And you're sitting there like, wait, what? I did the right thing. I stayed out of debt. How is that a problem? Make it make sense. If you've ever felt that confusion, that frustration, that quiet irritation like the rules are kind of backwards, you're not crazy, for real. You're noticing something real. Because here's the paradox. The system that measures your financial trustworthiness often rewards you more for borrowing money and managing it than for avoiding borrowing altogether. Let that sink in. You build a stronger credit profile not by proving you don't need debt, but by taking on debt and handling it well. That feels weird, almost like a setup, like the system is saying, hey, show us you're responsible by owing somebody. That's wild when you think about it. Most of us grew up hearing debt is bad, stay out of debt. If you can't pay cash, don't buy it. And honestly, in a lot of situations, that's solid advice. But then adult life pulls up and says, actually, we need to see your history with debt before we trust you. So now you're stuck in this strange middle ground. If you never borrow, you have no track record. If you borrow recklessly, you damage your score. And somehow the sweet spot is borrowing just enough to prove you don't need to borrow. That's the emotional tension behind the credit score game. Now let's move to the whiteboard. Imagine I draw 3 circles. One says payment history, one says credit utilization, one says length of credit history. Around them, I scribble a couple more, credit mix and new credit inquiries. This right here, that's basically the anatomy of a credit score. Not magic, not morality, just data. The biggest piece is payment history. Simple question. Did you borrow and did you pay back on time? Missed payments? That hurts. On-time payments? That helps. The system isn't asking, are you a good person? It's asking, when we give you borrowed money, do you send it back as agreed? That's it. Now, the second big factor, utilization, that's the percentage of your available credit you're actually using. If you have a credit card with a $10,000 limit and you're using $9,000, that screams stress. If you're using $1,000, that signals control. See the catch? You need available credit to show low utilization. No credit line means no utilization data. Again, you have to borrow to generate the data that proves you're safe. Then there's length of credit history. How long have you been in the game? A 10-year-old credit card account tells lenders way more than a brand new one. Time builds trust. But here's the thing. Time only counts if there's an account open. No borrowing, no clock ticking. Credit mix is another layer. The system likes variety. Maybe a revolving account like a credit card, maybe an installment loan like a car loan or mortgage. Why? Because statistically, someone who manages multiple types of debt successfully looks more predictable, more stable, less risky. So let's pause right here. Your credit score is not a measure of wealth. It's not a measure of intelligence. It's not even a measure of how much money you've got sitting in your bank account. It's a measure of how reliably you manage borrowed money. That's the math. From a pure number standpoint, lenders are asking one question. If we give you money, how likely are we to get it back plus interest? That's it. A credit score is basically a probability model, risk scoring. It looks at millions of borrowers and says, people who behave like this tend to repay. People who behave like that tend to default. And here's where the paradox gets sharper. If you never borrow, the system doesn't have enough data on you. And in risk modeling, no data isn't the same as good data. It's uncertainty. And uncertainty gets priced cautiously. That's why someone with zero credit history can actually be seen as riskier than someone with a long history of responsibly managed debt. Not because they're reckless, not because they're broke, but because the model doesn't know them. Now let's zoom out, system level. Banks aren't charities. They're not judging your soul. They're pricing risk. They make money when loans are repaid with interest. They lose money when loans default. So the whole system is built to reward predictability. If you show that you can borrow, use, and repay within agreed terms, you become statistically attractive, lower risk, better rates, higher limits. And that creates a loop. You borrow a little, you pay it back on time, your score improves. Because your score improves, you get access to cheaper credit. Because you get cheaper credit, you can finance larger assets at a lower cost. That can help you build wealth if you use it strategically. Meanwhile, someone who avoids borrowing completely might feel emotionally safer, but they're invisible to the model. When they finally need credit, maybe for a home, they face more friction, more scrutiny, sometimes worse terms. Is that fair? That's a different debate, but it is structural. The system wasn't designed to measure virtue, it was designed to protect lenders. Schools rarely break this down. Parents often say stay out of debt without explaining how modern credit infrastructure actually works. So people grow up thinking financial responsibility equals zero borrowing, only to discover later that the system rewards demonstrated borrowing discipline. That mismatch creates shame, confusion, self-doubt. But most of the time, you weren't irresponsible. You were just playing by incomplete rules. And here's another layer. Access to credit early in life often depends on family exposure. If your parents added you as an authorized user on a long-standing credit card, you might start adulthood ahead. If nobody explained credit to you, you might start from zero. Same intelligence, same hustle, different starting data. Over decades, those small differences compound. Better credit unlocks lower interest rates. Lower rates reduce total borrowing costs. Lower cost increase margin. Margin increases options. So yes, the system rewards borrowing, but more specifically, it rewards controlled, strategic borrowing over time. Now let's talk about exit strategy. This is not about running out and maxing credit cards to build credit. Relax, that's not the move. The shift starts with reframing. Credit is a tool, not identity, not validation, not self-worth. It's a lever. First, understand the game clearly. If you live in a world where major purchases require financing, having a solid credit profile is strategic. That might mean opening a credit card, using it lightly, and paying it off in full every month. Second, protect utilization. Low balances relative to limits signal stability. High balances signal strain. Show capacity without dependence. Third, think long-term. Credit scores reward consistency. One missed payment can drop a score fast, but steady, boring, on-time payments over years, that builds resilience. Fourth, separate borrowing for flex from borrowing for leverage. Financing a lifestyle you can't afford is different from financing an appreciating asset or managing cash flow intentionally. And here's the mindset shift that really matters. The goal isn't to borrow because you need to survive. The goal is to build enough stability that you could survive without borrowing, while keeping the option to borrow cheaply if it serves you. That's the paradox resolved. You build credit not to live in debt, but to reduce friction in a debt-based system. You don't worship the score, you don't fear it either. You understand it. Heart to heart for a second. If you ever felt judged by a 3-digit number, you're not alone. If you ever wondered why avoiding debt didn't automatically make you excellent, you're not wrong for questioning that. But once you see that a credit score is just a risk metric, not a moral grade, the emotional weight shifts. You stop taking it personally. You start playing it strategically. The real power isn't in chasing a perfect score. It's in understanding the rules well enough to use them without letting them use you. Because in the end, the system doesn't reward borrowing blindly. It rewards demonstrated reliability over time. And once you see that clearly, you stop asking, why do I have to borrow to prove I don't need it? You start asking, how can I use this tool without letting it control me? That's a whole different game. And that awareness, that's where real financial maturity begins. All right, if this hit home for you, you already know the vibe. Hit like, subscribe to the channel, and yeah, tap that bell icon so you don't miss what's coming next.